China's shares edged higher on Tuesday after a four-session losing streak as consumer and tourism stocks rebounded ahead of a week-long National Day holiday and amid the easing of COVID-19 restrictions in Hong Kong and Macau. Hong Kong's main stock benchmark, meanwhile, hovered around an 11-year low amid aggressive overseas monetary policy tightening and recession worries. The Shanghai Composite Index was up 0.3%. The Hang Seng Index dropped 1.1%. In the United States, Wall Street slid deeper into a bear market territory on Monday as investors fretted that the Federal Reserve's aggressive campaign against inflation could throw the U.S. economy into a sharp downturn. The S&P 500 lost 1.03%, the Nasdaq Composite Index lost 0.60%, and the Dow Jones Industrial Average fell 1.11%. The JSE's mixed at midday. The All-Share Index is up 0.37% at 63,864. The Industrial 25 Index has shed 26 points, while financials are 1.3% firmer, as the Precious Metals and Mining Index are 0.3% down. Markets in Europe are slightly firmer at this hour. Britain's FTSE 100 a tad lower, while the CAC 40 in France is 0.7% up, and Germany's DAX is up by the same margin. The rand is trading at 17.91 to the dollar, 19.34 to the pound sterling, and 17.24 to the euro. Looking at commodities, gold is trading at $1,637 and platinum at $859 per ounce, while the price of Brent crude oil is at $85.50 a barrel. Right, let's get some analysis on this. Martin Smith, a portfolio manager at Anchor Capital, joins me now. Thanks so much for your time this afternoon, Martin. U.S. markets ending lower again yesterday. Is there still jitters about what's happening with interest rates?
Yeah, absolutely. I mean, we're seeing a testing of the June lows at the moment. It's going to be interesting to see if it breaks through that. But yeah, your point is completely valid. It's all about interest rates, inflation, fears of a recession, as well as the kind of escalation that we've seen in the Russia-Ukraine conflict as well. So there's a lot of things that are making the market very nervous at this moment in time. We do have earnings season in the States coming up. So that'll be quite interesting to see how the earnings look from the big companies and what they're doing to kind of counteract inflation and the like. So we're all very data-driven at the moment, and we'll have to wait and see how things pan out of the next few days and weeks.
Martin, normally when we're doing the markets, we always say, Asian markets tracking the U.S. markets lower. That's not quite the full picture of what's happening, though.
No, it is a bit more nuanced on the Asian markets. Look, the sentiment will kind of flow through across the board, but there are nuances. We've seen the same with our market as well. We're not exactly behaving the same as you've seen offshore this week, as well as for the rest of this year. So there are nuances. There are certain markets that are cheaper than others. Asian markets being in that category is the same as South African markets.
When it comes to South African markets, we're closing in the green yesterday. Today, I want to say a mixed picture, but I'm seeing a little bit more red. So just talk us through what's happening in the South African markets at the moment.
Sure. So I think what we saw specifically yesterday and a little bit today is a little bit of bargain hunting coming in. So while you've seen quite a large sell down in the US markets, stocks still aren't looking like super cheap, probably trading at average multiples, looking back at history. But the South African market is quite cheap, so I think there's some bargain hunting coming on there. You also saw the Naspers and Process Stable also doing very well yesterday, so that obviously also picked the market up. So again, there's different things at play, but the fact that our market is looking quite cheap is playing in its favor at the moment.
And then when it comes to commodities, we saw Brent prices falling yesterday. Why was that, and what's happening with that price today?
Sure. So the thing with oil at the moment is we obviously saw oil price go up significantly kind of over the last 12 months or so, largely in the back of supply issues. That's obviously exacerbated by what we saw out of out of Ukraine and Russia. But what's happened in the last few months is people have started to get a bit nervous around the demand side of things, which is global slowdown in terms of growth and the like. So it's now been a bit of a demand story, and people worry that demand isn't quite there, which has brought the oil price right back again. So again, same with what's happening in the US. I think we just need to wait and see how things pan out from a growth perspective, and I think that'll be quite a large driver of where oil goes. There's still enough supply side issues to push the price higher if we see demand actually picking up. So very nuanced, and we'll just have to keep an eye on it going forward.
One of the stories that was quite big yesterday was that 18 Rand to the dollar mark. We're seeing now the Rand at around 17 something, back below that figure. Just what's happening there, and could we see it going back around that $18 to the Rand mark? 18 Rand to the dollar mark.
So, sure. So that 1780 level was a very key level technically. Once it broke out of that, it was around 1805, 1810 was the next kind of key testing level. I think what we have seen is a little bit of a carry trade come back into the Rand on the back of the MPC's decision to increase interest rates in South Africa last week. The dollar has been incredibly bulletproof. Like we mentioned at the beginning of the show, it's a lot of fear on the market. People are just going into kind of safe haven assets, and the dollar is the big beneficiary of that. But like I said, the Rand's starting to do a little bit better on the back of a carry trade, I think. But still remains to be seen how we get out from there. I think, again, 1810 is a very key level for the Rand dollar. The rest of the currency is all very weak still against the dollar, things like the pound.
Okay. Let's take a quick look at company news. We'll start with Remgro. Their results for the year ended 30 June 2022. Headline earnings per share up by over 120%.
Yeah, absolutely. So a nice number from that perspective, broadly in line with market expectations. Dividend was a little bit light. But I mean, the stock is now trading at a 40% discount to NAV. If you look at it historically, it's about 27% over the last 10 years. So looking cheap from that perspective. But I think the thing that we're seeing coming through is globally as well, is when you've got companies with these big CGTs in their investments holding companies, people are a bit worried about the CGT leakage that might come when they start selling these assets off. But the one thing that is a little bit positive is you've got Grindrod being unbundled from Remgro, which isn't particularly material to Remgro, but it does maybe talk to the fact that there might be some corporate action. So I think for people who like the share, they think that the discount of 40% might narrow down to 25, 30, 35, and there might be some more corporate actions, other unbundling going on. So that's for the bulls, their base case.
Then Tiger Brands seemingly shaking off those worries about asbestos in their baby powder, among one of the many challenges that company has faced when it comes to perception.
Absolutely, and I think it's part of the hazards of the type of business that they do, and when there's chemicals and things, there'll be sometimes issues with products and having to recall. So definitely is a kind of part and parcel, as unfortunate as it is of being in that side of the business. But they've provided a provision of 20 to 25 million Rand to look after that. The rest of their result was a lot better than expectations, which is why you saw the share price riding as hard as it has. In terms of going forward, would I be a buyer of Tiger Brands? Probably not. Happy to sit on the sidelines. I think they're still facing some headwinds. I think you've got a constrained consumer, and I think people might start to essentially buy down from premium brands to kind of your private label brands, which is obviously not positive for Tiger Brands. So happy to sit on the sidelines, even though it was quite a positive result from them.
Martin Smith from Anchor Capital, thanks so much for your time and insight into what's moving the markets.
Henry, what do you do for a living?
I'm in construction.
What makes it